Hi, everyone. We're just going to wait a minute or two, let some people enter from the waiting room. All right, I think we'll get started now. Good evening, everyone. Thank you for being here today and joining us for what we hope will be a really insightful conversation. My name is Mark Samson. I'm a senior partner here at XML Financial Group. Here at XML, we help individuals and families build financial confidence and clarity through every life stage, from just getting started investing to helping with long-term planning and generational wealth goals. Today's panel is designed for those who are just starting their financial journey, thinking about major life milestones, or helping a younger family member begin theirs. Our goal today is to share practical, real-world financial insights, and we will give you an opportunity at the end to ask questions. Also, we really would like this to be a conversation, not just a presentation. So if you have any questions along the way, please pop them into the chat or in the Q&A. Before we dive in, I'd like to introduce our panelists. First, we have Nicole Treiber. Hi, Nicole. Nicole is a new mom and a wealth advisor here at XML in our Bethesda, Maryland office, and she will be discussing how to plan for major life events. Topics like starting a family, moving, or career changes, which many young adults go through in their 20s or 30s. Next, I have Ben Kollender. Hi, Ben. Ben is a wealth advisor in our Fort Washington office, also my home, and is here to talk about the fundamentals of investing and retirement planning for those just beginning, including 401ks and long-term growth strategies. Excuse me. Lastly, we're joined by Zach Weaver, a wealth advisor and certified financial planner, who will be addressing some practical strategies for managing debt, optimizing student loans, and establishing a strong emergency fund. With that said, let's get started with Nicole and her topic of major life events.
Thanks, Mark. We're going to put a poll out. We want to ask a question and see what you guys think. The question is how many of you are planning or know someone who's recently had a major life change, whether that's moving, starting a family, getting married, career change? So the poll is up. Please take a minute.
I did the poll.
Okay, great. All right. Yes, I would expect that majority of people are having changes in their life. That's what makes life so exciting, is it's always filled with changes. So we're going to go over a couple of these items. But yes, I know someone who's planning a life change. Yeah. So the first question that I get a lot from people when they're having a big life event, especially a family, is how should someone think about balancing savings for major life events? For instance, we'll use buying a home and retirement planning. And there's no, you know, complete answer to this equation. It is really what fits you both. But usually, how it starts is just recognizing your goals are both important, but they serve completely different purposes. For instance, the retirement aspect is a long-term necessity, whereas buying a home is a short-term goal, which is also usually tied to a lot of emotions, the excitement of getting that first time home or second home. So I usually encourage my clients to make sure that they're at least building a foundation for retirement, especially if there's an employer match. That is something that you can't catch up on, and you don't want to miss out on what I call the free money that your employer is giving you. From there, it becomes aligning the rest of your savings with a timeline. If buying a home is a near-term priority, it's okay to direct some of more money towards that goal. But again, not all of your money should be going there. Do not pause retirement. It's less about perfection and more about balance and consistency. You want to make sure that you are reaching several goals that you have running at the same time because both of them, like I said, are important. The next question that I get a lot is about children. And like Mark mentioned, I'm a new mom. And the question is having children part of your future plan, or if you're starting a family, what financial decisions matter most early on, such as cash flow planning, childcare costs, education savings? And the number one thing is you want to make sure that you prioritize and have an idea of what's coming in financially and what's going out, so your expenses. And then what you want to prioritize is insurance, life insurance, disability insurance, because God forbid something happens to you, you want to make sure that your child is taken care of. One of the quickest things that I realized, and a lot of people told me this was going to happen, was my priority shift. But it's one thing to hear that, and it's another thing to completely experience it. So your priorities do shift, things pop up unexpectedly, and you need to change for that. So one of the things that you can plan for is childcare. And then the other big question is education savings. When do you start that? How soon? How much? At what expense? And again, like I said in my first response, do not stop your retirement savings. Yes, save a little bit for education if you can, but you're not going to be able to have your kids take care of you in retirement. So it's always important to make sure that you're taking care of yourself, so that way you don't want to become a burden on your children. I always wondered if my opinion on that would change once I had a child. Um, and it didn't. I still completely encourage my clients to make sure that they're doing the best that they can for their retirement savings and doing what they can for their children. Their children shouldn't typically get mad at them because they didn't pay for everything, but they would be possibly upset if they ended up having to take care of you financially through your own retirement. Um, so based on that, I had a question for Mark. And Mark, if you had to give someone advice, and I also want to
Mm.
bring Zach into this because he's also a new dad, but if you guys had to give someone advice, whether they're a new parent or young and looking to save, what would you guys tell them?
Sure.
Zach, you want to go first?
Yeah, absolutely.
Go ahead.
One few things I'd say is, keep a few dollars extra in the monthly budget for unexpected expenses. It's not all black and white when you have a kid. Things come up all the time. And Nicole, I think you hit on it, and I think we should reiterate childcare. That is the largest expense per month that you will incur with a child. Depending on where you live, it could be $1,500 all the way up to $3,500 a month. Many people try to plan for that after the kid's here. Doesn't really work out well. You should try to focus on that before the family's here. And then again, insurance, life insurance, disability, those are no longer negotiables, right? If something happens to one of you, like can your family survive financially? You want to eliminate that risk. And then education savings, even if you start with $50 a month saving into a 529, time is the biggest asset. So saving $50 a month today is very different than $100 a month when the kid is 10. So just saving as much as you can early on. What about you, Mark?
That's great. Great advice, Zach. I absolutely agree. I'm the old guy of the group here. And, the one thing I will tell you is time flies. It goes so much faster than you can imagine. The analogy these guys have heard me say a million times. Someone once said, life's like a roll of toilet paper. Closer you get to the end, the faster it goes. And as the old guy in the group, I'll tell you, it goes pretty fast. So, plan ahead, think about these things. There's certain easy things. These guys as new parents, you know that you're going to have a kid that you may want to go to college in 18 years. So start thinking about it now. Don't wait until they're 15. As Zach said, whether it's 50, $100 a month is all you can save. That's great. Something is better than nothing. We all have these goals in life. I want to retire at 65. I'd like to buy a second home before we retire. I want to be married at 30. I'd like to buy my first house at 35. Set some goals, set some goals, realistic goals, and plan for them. Someone once said to me, nobody plans to fail. People fail to plan. And I think there's a lot of truth to that. So if you just take the time to think about where you want to go and talk to us, your advisors, to help plan for it. It will make it a lot easier. I'm sure we're going to touch on some more. I know I have some thoughts in my head that I want to bring up later about this, but it's really just taking the time to think about your goals and planning for them. So that was great. Nicole, anything else
Yeah,
there?
I think it's just important to know too is when life changes come at you, it can really weigh on your shoulders and just know that you're not alone. And
Well said.
having a financial advisor to speak to takes a lot of burden off. We're really great sounding boards.
And there's a lot of things that we've seen that we can help you navigate. And yes, that's the only thing I can promise you is there will be curveballs thrown your way. So prepare for them and learn that you will get through them. All right, thank you, Nicole. Ben, I think it's time to pivot over to you. Why don't you tell us some common questions that you get on the topic of 401ks, investing, saving for retirement, all that good stuff from the millennials or Gen Zs.
Awesome. Thank you, Mark. Like Nicole, I'm also going to start with a poll question here. So this time around, the question is, what percentage of your income do you currently contribute to a retirement account?
Not letting me vote.
Neither. Tried to vote on that one. All righty. Looks like a pretty wide range here, which is as expected. And what's great, and we'll get into sort of the why, but there's not really one right answer here. As Nicole alluded to, as much as in our world, there's no one right answer. It's very specific to you and your individual situation. That said, one very common question we do get is how much should I contribute to a 401k? The other piece of that is, should I be working with an advisor for where those funds are allocated once they're in my 401k? So let me start with the first piece of that. Again, there's no one real right answer. It's very dependent on what you can afford to put away and not having your current savings and what you can afford to put away to save for retirement and solely for retirement. One short answer is, which I think is obvious, the more you can save, the better. But that being said, we know as young professionals and also based on the poll results, that's not often feasible to put away the max that you are allowed in your 401k as a young professional. Just so everyone knows, if you did not know, for 2026, that number is $24,500. That's the max up to age 50 that you can contribute in your 401k this year. But again, assuming most young professionals are not able to make that work financially. One sort of baseline metric we like to think about is, can you save 10% to your retirement account? That's a really strong number still. That's still a pretty high number, but it gives you a really good base for retirement savings. And of course, as your income grows, you look to increase that over time. But that's a number that we often like to sort of use as, can you afford and can you handle 10% towards your retirement account? Now, if that still doesn't feel feasible, again, that's still a pretty aggressive number. That's a really good savings number. And Nicole began to hit on this as well, and we'll just kind of hit it home here. If your employer offers you some kind of match, that is the number, whatever the minimum is to take full advantage of whatever they're offering. That's the number we really want you to be able to hit. So I'll put some numbers behind this. For instance, very commonly we'll see for every dollar the employee contributes, your employer might contribute 50 cents for every dollar, up to 6% of your employee contribution. So what does that mean? You contribute 6%, they'll match 50 cents to every dollar you put in. Now, instead of just the 6% you put in, you put their match with it, nothing out of your pocket additional, but you're now at 9% instead of the 6%. That's very close to the 10% number that we just told you was a good one to target. So it's a really neat way to get you to that point without actually feeling the burden of maybe contributing the full 10%. So minimally, we really advise you strongly to take full advantage of the match if given. The other piece of that question is, should you work with an advisor on how these funds are allocated? Now, this one's actually a little bit of a frustrating one to have to answer, because the legal answer is advisors like us who work more with individuals actually cannot give direct advice on how you should invest those funds. Now, two pieces of info that are important there. One, the plan itself very often will have an advisor associated with it. For instance, we at XML are the advisors on dozens of retirement plans where we actually can talk to the participants, and we'll go and meet with these clients or participants and discuss what makes sense for them. Now, for our purposes, for those that were not managing your 401k, but just kind of our regular clients, we want to be able to help, but there's some limitations. But what we often will try to do is give you some guidance, educate you as best as we possibly can, and sort of point you in the right direction. We do what we possibly can to help, but there are some limitations to what we can technically advise you on. So again, a little bit of a frustrating one, but important that there's often a resource available to you. If you talk to your HR department or whoever at your employer is in charge of your 401k or retirement plan, they may point you in the direction of the advisor on the plan. Like I said, we are that, and it's great to have that resource. Second question. There's different kinds of contributions to retirement plans. There's the traditional pre-tax, and there is Roth, which is also called after-tax contributions. Which one's better? How should someone choose which they should do? How do you come to that decision? So first, before getting into how to make that decision, I think very quickly it makes sense just to explain a high level what's the difference. So first, traditional pre-tax 401k. What that does is, just say you get paid every 2 weeks, which is very common. Your paycheck comes in. Before that hits your account, your savings account, or your checking account, money is being pulled out and contributed directly into your 401k and invested in your 401k. That happens before that money's taxed, which does a couple of things. One, it reduces your taxable income now, which is a tax break now because you have less income being taxed. What that does is it then goes in the account and grows tax deferred. So you're going to have no tax burden as the money grows over time. It will compound on itself. It's a great investment tool for long-term investing. And then when it comes out in retirement, that is then when you pay the tax on those dollars. As they come out in retirement, it's taxed as income. That's sort of the traditional 401k that's been around for a while. What's newer is the Roth 401k. And what that is, slightly different, but a pretty significant change, is that those dollars go in after tax. Roth dollars, you pay tax on them today. What does that do for you? The first, which may be obvious, is it makes it a little bit more expensive today to contribute the same amount percentage-wise. If you're paying tax on those dollars as well, it's more expensive to you today. But what that means is that because you pay tax on it today, you get to retirement, it grew tax-free through your working years, and then you get to retirement, it comes out tax-free as well. So that's a really beneficial tool, is to have a tax-free bucket of money in retirement. It's something we really like, particularly for sort of the demographic on this call right now. If you're a younger professional, you're likely in a lower tax bracket than what you may be when you're in retirement. Therefore, we think it could make a lot of sense for you to, if you can afford it and live comfortably and pay the tax today, we think it makes a lot of sense for you to consider some Roth contribution. Now, I say some because there's not one or the other oftentimes. A lot of times, it could be some combination of both, which is something we often will guide clients to do. If you want to contribute 10%, but you can't stomach or afford paying all 10% tax now and wanting to do 10% Roth, then maybe you do 5 and 5, 5 pre-tax, 5 Roth. Something like that could make a lot of sense, and it's often something we'll give guidance on doing so. So again, there's not really one right answer, but both really good tools for slightly different reasons. And again, the combination of both could be the best for you. Last question that I think we get a lot, again, particularly from the younger professionals, is in your retirement plans, should I be buying stocks? What about crypto? What about alternatives? Sort of these speculative investments, we like to call them. The kind of short answer is it's up to you, but we really don't advise you being super heavily concentrated in any one position, regardless of if it's speculative or not. Again, you want to avoid concentration risk as a whole. And that's really just so if something goes wrong with whatever you are invested in, it's not deteriorating your entire plan. You don't want any one good or bad to make or break your plan. We like to diversify. But that being said, we do know, particularly with crypto, with younger professionals, it's very intriguing. It's exciting. But there's also not a very long track record of crypto. And also, it's very volatile, which isn't a good or bad thing. There's been some people that have hit home runs. There's been some people that have gotten crushed. That being said, kind of putting all that together, if you want some exposure to crypto, we're not going to be the ones to tell you no. And there are some abilities to do so in retirement plans through employer-sponsored plans. But we would advise you maybe limit how much. Maybe consider a 5% allocation or a 10% allocation for every contribution. Nothing, again, if something goes great, awesome, it's icing on the cake. If something goes terribly wrong, it's not going to deteriorate your entire retirement. That's generally how we like to think about it. And again, that's not just with those speculative investments. That's really just investing in general. We don't want too many eggs in one basket. It's kind of the old phrase to describe that. You don't want too much concentration risk in any part of your plan. So that's kind of retirement planning in a nutshell. And that kind of brings me to a question for Mark. In your experience, what's the biggest benefit you see from your older clients who have really prioritized saving in 401ks and retirement plans?
Thanks, Ben. Good presentation. That's it's really pretty simple. If you start early, you will reap the benefits later in life. I'm 58, I've been doing this for 35 years, and we now have clients in their 70s and 80s with retirement accounts. 5, 6, 8, $10 million is not uncommon. And it all comes from starting early. I did a quick analysis expecting a question like this. If you're 30 years old and you have saved $50,000 for retirement, all right, so let's just say from 23 to 30, you were able to save 50,000, or even it grew to 50. Maybe you only put in 25 and it grew to 50. If you stop contributing at age 30, $50,000 is in your account, you stop contributing. Not recommending that, but just using this as an example. If you let that sit until retirement age, and I'll use a number of 66, that $50,000 will grow to $1.6 million. You young people can check me with ChatGPT, whatever you want. $50,000 investment, earning about 10% a year, will grow to about $1.6 million a year, about $1.6 million by age 66. So what's interesting, I'm just now thinking about Ben's example of a traditional 401k versus a Roth. Imagine you did the Roth and you accumulated $50,000 in a Roth by age 30. You will have $1.6 million tax-free that you can then now withdraw in retirement. If you did it in the 401k, the traditional 401k, yeah, you would have saved some tax dollars getting that 50, but now you're going to pay tax on 1.6 million. So I would say the general rule I have seen to answer Ben's question is the power of compounding, just letting that money sit there. The formula we use really is, well, first I'll say one saying, it's time in the market, not timing the market. That is critical. So that example I just gave you is 36 years. There were good years, there were bad years. People are like, oh, I'm not going to invest in the market now. While now might feel like a volatile time, I think it's, just always a good time if you're looking out 20, 30, 40 years. So, just use that example though, of $50,000 invested at age 30, grown to 1.6 million at age 66. That is using, I was going to say, there's a formula we use. It's the rule of 72. Take what you earn, divide it by the rate of return. That's how long it takes to double your money. So I double this money every 7 years approximately, which means you have to earn 10% on your money, which is an approximate stock market long-term return. So I hope I answered your question there, Ben. And I hope you guys all learned a little something. If Ben is done, I think we're going to pivot to Zach Weaver, who's battling a little flu or cold. So, Zach, thanks for joining us. He's going to address the not so much fun stuff of credit, budgeting, and debt. Certainly not everyone's favorite topic, but it is one that we need to discuss and important. So, with that said, Zach, I'll let you get us started. Thank you.
Thanks, Mark. So yeah, I have a lot of friends and clients that I work with, and I really set up long-term financial plans for them, focused around paying down debt, reinforcing their emergency funds. And like you said, it's a tricky topic and not so much fun, but it's very important, especially working with an advisor like any one of us, so you can manage your debt while still moving forward towards your goals. People think it's one or the other, but I don't think that's the case. So the first question I get asked a lot, and it's not just by people that are younger, but clients or friends of all ages, should I pay off high interest debt or invest more? I think there's a general rule, especially with where rates are today. If you have debt with interest of 7% or more, every dollar left in that debt is already costing you. So that's something you could stop as soon as today. You could start paying that down. But I think there's a real sweet spot by eliminating that high interest debt and also building the habit of investing, even if it's that $50 a month, like Mark said with education. Something is better than nothing. And the consistency matters as much as the math because it locks in that behavior before lifestyle creep sets in later in life when you will earn more. And I think that's the key takeaway here. It's less about the perfect allocation and more about not letting debt be an excuse to never starting to invest. And again, like Mark said, I think he said it very well. It's about time in the market, not timing the market. And that naturally raises the next question I hear almost all the time is, okay, should I even invest if I am carrying debt? Yes, absolutely. One thing you can think of, like Ben mentioned, right? Never skip on contributing enough to your employer's retirement plan. If they're willing to give you a match, don't let that money sit on the table. Contribute enough to at least get the match. That way you can focus on paying down debt and you're saving for retirement. I don't think anything else really competes with that. And then after that, after the match, it comes down to the rate of your debt, right? There's good debt and bad debt. The good debt is, a mortgage or an auto loan that's not extended too long. So you can invest alongside of that. But when you have bad debt, like credit card debt that you keep carrying, we typically see those rates in 18 to 20+%. You should probably prioritize this because that is a lot of capital, a lot of your money going towards the debt that you could be investing as well. And then another question that I get all too often is, okay, I have debt. Should I be making excess payments over that minimum to build an emergency fund? I think if you're making those excess payments, yes, you should probably take a pause if you don't have an emergency fund. Because a lot of people think an emergency fund is the savings goal that's up here, but it's not really a savings goal. I think it's a protection against any catastrophic decision making or those unexpected life events, right? If you get let go of your job or your car breaks down, whatever it may be. Without one of those, the first major unexpected expense sends you right back to the credit card. You're accumulating more debt with higher rates of interest. And if you do have any investments, you might have to pull from those in down markets. And you just go in the cycle over and over and over. And I see a lot of people that can't escape that without coming to us, and we build a plan how to get out of that. So what I like to tell people is start with, 1 to 3 months of fixed expenses. I know a lot of the time you're going to hear save, 6 to 12 months. That's not always doable. Focus on what you can manage. So maybe it is 1 to 3 months. And then as you're paying down debt, let's work towards the 3 to 6 months of all of your expenses. And then once we have that cushion, if anything were to happen, now we can take on those excess debt payments again. Now, I think something worth mentioning around debt is people think it's all about credit cards or auto loans. One of the biggest forms of debt for millennials and Gen Z, student loans. And does it make sense to refinance or consolidate? It depends. If you have federal loans, I would proceed carefully and talk to an advisor. Because if you have a large amount of student loans on the federal side and you want to refinance, you might give up that income-driven repayment plan, or I think it's going to be called the repayment assistance plan, or even public service loan forgiveness. You give that up the second you refinance into a private loan. So when I see people do that without consulting one of us, they tend to regret it. And if you want to refinance them, it only makes sense if you have a high, stable income, no realistic path to forgiveness, and the rate reduction is significant. Typically over 1.5%, you're going to save on the interest on those student loans. And then on the other side, you have private student loans. That's a different story. Typically, later in life, you have better credit because as you pay student loans down, your credit history builds. So as that builds, you're probably in a better position. You can refinance those to a better rate, something you can afford more while paying down debt and investing. And then if we look at it as a whole for debt, a lot of people think just consolidating multiple loans, credit card, auto, student loans, all into one big loan makes sense. It can work, but psychology often defeats the math here. You roll up a few debts into one, and it's a lower rate. You feel the relief. You don't have all these payments coming out each month. But you start using up those cards again because now you don't have a balance on them. Treat this consolidation as a legitimate tool only when the original credit lines get cut at the same time. So without that, I think you're really just reorganizing a mess rather than solving it. So those are the questions I get typically around debt. Mark, I have a question for you. For someone that's younger and struggling with debt, what would you give them for advice or something that you wish you understood when you were younger?
That was great. Thank you, Zach. First thing I would say, call Zach. Just
There
kidding.
you go.
I mean, no, what I love about this is, we're financial advisors. People think when I have money, I call a financial advisor. No, we're also here to help with this side of your, financial picture too. First thing I learned in, I don't know, I guess it was accounting, is assets minus liabilities is your net worth. So if you can just eliminate some debt, you're really doing as good as putting money into an investment. Um, so people who are struggling with debt, as you said, Zach, there's good debt and bad debt. Focus on the bad debt first. take care of that. The credit card's at 18 or 21%. Reach out to us. You want to eliminate the most expensive debt because many people never get out of it. Look at that credit card bill. If you make the minimum payment, this will be paid off in 27 years. That's very often what it says. So credit cards are dangerous. Yes, they're often a necessity, but they really are something you want to avoid if at all possible. Um, what else would I say? Focus on the goals again, focus on what's really important. Something I tell people is weigh your expenses. Look at what you're doing. I'm a huge fan of Wawa. I'm assuming most people here know Wawa. It's our mini mart in the Philly area and wherever, much of the East Coast. Wawa, you can get a cup of coffee for $2. If you just go to Wawa and get a $2 cup of coffee versus Starbucks at $5, do the math. You're saving $600, $700, $800 a year. That could go to pay down debt. Call me crazy for saying that, but it's little things like that of changing your habits. Some people should never have a credit card. Use a debit card. That way you're only spending your own money. And we're happy to help strategize, but we help clients, navigate that high levels of debt that can come with life too. Unfortunately, the financial industry has gotten creative and allows people to buy things that they probably shouldn't be able to buy through creative accounting. Today you can go and buy a TV and pay for it over the next 3 years. To me, if you can't afford to buy the TV today, you probably shouldn't be buying it. Just using that, as an example. So no, that was really good advice, Zach, and very helpful. Hopefully some others found it helpful too, not just me. Um, I think that was great. So thank you, Zach. Anything else on your front there, Zach, you want to cover?
I think those are the main points there.
Okay, great.
Thanks for your little advice there. That was helpful.
Of course. So I think we got some questions that have come in last half hour or so. Nicole, do you have a couple questions that we've received? I think I saw a few. Unmute, Nicole.
That would help. Yeah, we got some questions. The first one I see is, do Roth and 401ks grow at the same rate? So I'm going to take this question, and it all depends on the investments inside. If you have SPY in your 401k and SPY in your Roth, yeah, they're going to grow at the same rate. These accounts are a vehicle, and it all depends on what you put inside the car that will take you to your end goal.
But yes, I think you answered it perfect. But I think I would just clarify that if the investments are the same, yes, your return will be exactly the same. The only difference really is that you've paid the taxes ahead of time in the Roth piece. Good question, though. That's a very good question.
Another question is, what is the best financial advice you have in terms of saving money for the future for those of us in between the age of 25 and 30? Ben, do you want to take this one?
Could defer to somebody in that age range.
It's a great question. I think first is making sure you're on track for retirement. I think it's a really good place to start. We were just talking earlier today amongst ourselves. There's lots of things you can borrow for in life. One of them is not retirement. And I know I worded that poorly from what Zach had earlier, but the idea is that you can borrow for education. You can borrow for a house. You cannot borrow for retirement, excuse me. So you very well may have other financial goals, and those should be addressed as well. But I think it's really important to make sure you're on a good track for retirement, as well as looking to establish savings for not just the long term. Of course, you have a lot of years in your life. If you're 25 to 30, you have a lot of years in your life until retirement. But I think that's a good baseline to start with, is focus getting that established, and then also look to allocate elsewhere for immediate, emergency fund type savings. That's also really important to start with, as Zach was saying. But then also building that sort of midterm bucket, as we like to call it, mid to long term, which might be a non-retirement investment account of some kind or something similar. I think those are some really good places to start.
Well said.
One little thing I want to throw out that I don't think we touched on. there's rarely enough money to go around to do everything, people. You know,
Mhm.
I know a lot of wealthy people, they can't afford everything that they might want. So just keep that in mind. You know, there's rarely enough money to max out my 401k or do the 10% or whatever, and to live in the apartment I want to live in and to have the car I want. So just prioritize. And just like we say with investing, spread it around, do the same thing. You know, spread out what you enjoy. Um, and live a good life doing that. And you'll reap the rewards later on if you live that, following that kind of philosophy.
I have a good debt question from someone for our honorary debt guy for this evening, Zach.
Good debt question.
There
Okay.
we go.
How do you recommend using a credit card wisely so you don't have a big statement at the end of the month?
Good question. I was told just because you can afford something doesn't mean you should buy it. And I think that is something we should all remember when using a credit card. So, how I like to look at this is I use a credit card to earn reward points. I will only use the credit card if I can afford to buy whatever I'm buying 2 times over. So,
Hmm?
if I want to go buy, I don't know, a shirt and say for some reason the shirt is $100, I want to make sure I can afford $200. That way, I'm keeping a buffer in case there's any unexpected expense that comes up, and I can clear that balance each month. And if you can't clear the balance, now you have a buffer to pay that extra payment down on your credit card so you can chip away faster. Hope that helps. It's kind of my philosophy.
Good
That
one.
was
I have one thing to add that's not exactly that question, but just in general with credit cards, make sure you're reading the statement. Check the statement every month before you pay it. I think it's simple. I think a lot of young people get very in the habit of auto paying where possible. It's always possible with credit cards now. Stuff pops up. It doesn't necessarily mean it's fraud, but it could be a subscription that you signed up for 3 years ago that you totally forgot, and
Yeah.
the annual $150 goes off, and you're like, I haven't used that in 3 years. That sort of thing can be found if you do review your statement. So I think really important to do that and not just not just getting in the habit of, even if it's not auto paying, just seeing the balance and paying whatever it is.
Great
Yeah, that's a
advice.
good point.
That's good advice. I'll tell you a real funny one. Again, I'm the old guy here in the group, but I have a friend goes out to dinner with another couple, and they go out to dinner. The credit card, the meal is $120, and one of his friends goes onto his credit card app and pays $120 right after the meal. So his balance at the end of every night is zero. It's funny. It's like I laugh. I think it's bizarre. But people like to do that. I will tell you, my kids, they pay their credit cards as the month goes on. The balance gets up to $500, they pay $500. They don't wait for the bill to come in. And I will say, whatever works for you, that's great. If you don't like it to get a big bill and you have a few dollars, you want to pay it as the month goes on, that's wonderful. This crazy guy who pays it right after the meal, that's fine too. Whatever works. All these little
Like that.
helpful things, though, are great.
Another question is, what is some advice for those of us looking to buy our first house, and how much of our money should we put down to be able to pay that off within a reasonable time without it hurting our future financially? We were all just discussing this before this webinar, and I'm a believer. I've bought a couple homes. I'm a believer in putting 20% down and making sure that I'm buying a house within my means, right? It's just because you can, like Zach said perfectly, just because you can afford something doesn't necessarily mean that you should be buying it. The other little trick that I do to pay it off quicker is I pay an additional few $100 every month directly towards my principal. And that is going to cut down my years of this loan and save on interest substantially. Do any of you guys have any other advice on this topic?
Yeah, I
Yeah,
think that's great. Go ahead, Zach. I'll go after you.
I think one thing that's important, most people focus on this down payment, right? There is another side when you buy a house, and it's called closing costs. And that's typically 5 to 7% of the purchase price. A lot of people forget to, add that in. That's a huge expense. So when people come and they're ready to put an offer in the house and their offer was accepted, they get this wonderful closing cost bill and we're like, whoa, we didn't plan for that. So one thing I like to look at is, can you afford 20% down payment? If you can't, I think it warrants an honest conversation. Maybe we can't afford this house because that's not the only bill you're going to pay. And you're not only paying your mortgage each month, you own the home. So you're on the hook for everything that comes up. So keeping those two things in mind, I think really helps you plan for that house purchase. Mark, what
Yeah,
were you going to say?
I think that's great, Zach. Yeah, no, there's a lot to own. Houses are, they say, money pits. There's a lot more risk to owning a home. I think it's wonderful when the time comes. But yes, there's a lot of unexpected costs that come with mortgages. Don't forget the real estate taxes. Don't forget the insurance. Don't forget the HOA fees. There's a lot of other costs. And I also feel there's more risk too, in that home values don't always go up. If you buy a house and you live there 3, 4, 5 years, you could lose money. So, you need to keep that in mind. Interesting statistic, and I'm just throwing this out there for people to hear. The average age of a first-time home buyer now is 40 years old. That blew me away. I don't know whether millennials, et cetera, Gen Zs are not interested in owning a home or whether you can't afford it, but it's interesting. People really are not rushing to buy a house today. And it could be that they're focusing on enjoying life. Maybe they're trying to save up the money for the down payment, but it's fascinating. My generation, we wanted to buy our homes at 25, 28, 30, whatever, very much younger. But no, these questions were great. Any other, Nicole?
One last one, and then we'll let you wrap it
Yeah.
up for us, Mark.
All
Um,
right.
the
Let everybody get to
potential,
dinner.
yeah, how does the potential for AI disruption change the way you're advising clients today?
Oh,
I'll take that one.
go, Zach.
I think with all the advancements in AI and how they're continuously changing almost weekly at this point, it's only making our recommendations and how we look at people's financial position and their goals even more efficient. It allows us to process data faster and think of things that aren't top of mind. Hey, we noticed this on your tax return. Have you explored this? And we can go down that route. We we don't really think it's gonna, take away all these jobs. It's just gonna make the efficient people more efficient. It's really about getting data, sifting through it quicker, and then we have conversations face to face or Zoom. Let's talk about your goals. Here's how we can do it. And AI will, show us those hidden spots that we might not always, pick out at first glance.
Great. Good answer. I'll also just follow up. Please realize that a lot of what you hear out there in AI world is not accurate. So
Correct. Correct.
that's where I think people like us will help people, decipher the information and help keep it more truthful or accurate.
Well said.
Well, this was great. Before we officially wrap up, I just want to take a minute to thank everybody for joining us tonight, bringing such thoughtful energy to your questions, and hope we answer them. If you have other questions, please reach out. Huge thank you to our panel, sharing your perspectives from the Millennial and Gen Z viewpoint on planning for life milestones, etc. Hope this gave you some practical tools and ideas you can start thinking about today. If you'd like more personalized guidance, please reach out to us, any one of our advisors, using the link that we've shared. And our team at XML is happy to be here to help you, and wish everybody a good night. And thank you again for joining.
Thank you, everyone.
Thanks all.
Take care.
Thanks.